Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Get Ready, Real Estate Investors.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today we'll be talking about the opportunity for real estate investors who are ready for the coming troubled assets. So let's talk a little bit about this. What are troubled assets? I mean, obviously, if you've been a real estate investor for any period of time or for a long period of time, you'll understand what troubled assets are. But we have a lot of new investors who watch this podcast, and I'd like to kind of address that. A troubled asset is anything that a bank is looking at for a potential for a foreclosure, whether it's voluntary or involuntary. So it could be what we call cash for keys, where somebody just calls up and does a deed in lieu of foreclosure. They're saying, "Hey, there's no way I can maintain this property, this house. I want to move out of it. I want to move out of this condo." And bank, in order to resolve this so you don't have to go through the whole legal process, I just want to turn the keys back into you and generally the lenders will give a little bit of cash for move out assistance to make sure the property is in good shape. They're not required to, but that basically is a deed in lieu of foreclosure. That's what we call a troubled asset. Another troubled asset would be a foreclosure. Somebody who no longer can make their payments, can afford the property. It could be a job loss. It could be a family member loss. It could be an accident. I mean, there's a whole myriad of reasons why people face foreclosure. It doesn't necessarily have to just be the lender who's foreclosing on it. It could be an HOA that's foreclosing on it. It could be a tax lien from a municipality or state agency. It could be a violation lien. There's a lot of different reasons why foreclosures can happen, and that creates a troubled asset. The other one, and the growing one that we're seeing across the U.S., I think, is the troubled assets that fall into the short sale classification. Now, I don't want you to get all surprised and go, "Wow, what are you saying? Is this going to be like 2008, 2009, 2010? No, I don't think we're looking at anything like that. But the numbers of short sales, the number of people who are facing issues with their real estate has increased. We got to go back a little bit, but if you remember after COVID, there were a lot of lenders who made concessions with homeowners in order to keep them in under COVID because they couldn't go to work, they couldn't make their mortgage payments. So in many cases, they deferred the additional balance to the back end of the mortgage, or some of these were just delayed and had to be brought up, and it just didn't go away. Interest continued to accumulate, money was still owed, and what we've seen over the last probably 18 months, I mean, it's been a very minor tick up, but I think as we came into the first quarter of 2025, the bills started to become due. The horrible real estate market, employment market that existed under Bidenomics, under the Biden administration, was piling up. It was running up. We could see how bad the real estate market had come as far as the sales numbers. People couldn't move because of interest rates. There were a lot of things that had put pressure on this market. And the reality is, if you go back a couple of years ago and listen to this podcast, listen to the weekly real estate update that we used to do, there were a lot of announcements of business closures, business that were just closing. Well, when those businesses closed, like when Big Lots went into bankruptcy, Joanna's went into bankruptcy, and, the list goes on and on. There were a lot of layoffs in the last couple of years due to that. And as good as I think the underlying factors are now in our economy, we are experiencing some troubled asset issues because of the lingering financial situation that existed. I don't think that we're actually going to experience or feel the benefits of the changes that have occurred since mid-January, January 20th, when the presidential change took place. Since January, I don't think we're going to fully start to experience those until next year. It just takes some time for the the tax benefits, some time for the production benefits, time for the manufacturing growth, all of those things to hit the marketplace. So the reason we would have some of these troubled assets is because the economy was really bad at the end of the last administration, and it was getting worse. But you weren't going to see it like we are now. Numbers always linger. They always trail. So for instance, if we have somebody who's having a problem making a mortgage payment, somebody who's having problems making a car payment, somebody who's having problems making a credit card payment, those numbers will show up in late payments, but they won't show up in repossessions, in foreclosures, and those type of things until somewhere down the road. So for instance, if you lost your job today, your mortgage payment may not actually be late for 60 days from now. And then 90 days after it first becomes late, it won't become a pre-foreclosure. So there's a trailing effect that I think we're starting to see in the economy. In 2023 and 2024, the number of lates on credit cards, the size of the balances on credit cards, the numbers of delinquents on auto loans, and beginning to see the number of lates on mortgages had increased substantially. But I think what we're starting to see is that come due. So the reason why we're having troubled assets is because of where we've been. I think that things are going to begin to change. We see that inflation is way down. It was very interesting to watch the news cycle here about a week or two ago when June inflation numbers were announced, and they'd hit a high of 2.7%. But actually, when you dug into them and you looked at the CPI and the wholesale numbers, you see that actually things were decreasing. But we had a spike in June, probably related to the issues that had happened in Iran and the potential oil markets. Oil prices jumped up, and energy obviously is a big part of inflation. But those have all come back down, and so we are seeing a lot of positive in the underlying economics. But we are seeing an increase in unemployment. The good news is we're seeing a huge increase in unemployment in the government sector. Now, if you're a government employee, I've worked for the government before. If you're a government employee, I know that it affects you, and for you, it's not good news. However, for the country as a whole, it's great news because that means that the government is spending less money. The less money the government pumps into our economy, whether it's through wages, whether it's through grants, whether it's through whatever means by supporting some failing banking system or whatever it is, then the more money they pump in, the higher inflation, because now you got more dollars chasing fewer goods. But we've seen a very good reduction in government employment. We've seen that the lawsuits that were filed to stop most of the government, firings have been overturned, and the administration's moving forward. I think it was the EPA just announced a 23% reduction. The Department of Education has announced that over the next 3 years they're planning on a 100% reduction. USAID has been completely shut down, rolled into the State Department, and most of those employees have been dispersed to let go. And so there's a lot of government employing dropping, which means less money being pumped into that. In addition to that, Trump's tariff plans, which the Fed has claimed would be inflationary, has not increased inflation at all. In fact, his import goods were down like 0.8% for the cost of import goods. So it's had just the opposite effect. But what it's done is it's brought over $100 billion back into the government. And that's money that helps to either pay the interest or pay the debt itself. And that actually lowers inflation. The good news is we're seeing job hirings. Job hirings may not be as rampant and as quick as some had hoped for, but what we are seeing now is we are seeing job hirings by U.S. citizens outpacing job hirings from non-U.S. citizens. In fact, as the non-U.S. citizen employment market is falling very rapidly, while the U.S. Employment market is increasing. And so, why is that good? That is good because a lot of times non-U.S. born people who have employment here in the U.S., they send a lot of that money out of the country, where U.S. born or citizens tend to keep that money in the country. They typically keep it here. They spend it on goods and services here. They help their families and economy here. And so that's better for the U.S. It's spurring the economy. And now we're seeing manufacturing helping. So why do we have some troubled assets right now? We do have a greater number of unemployment. Again, there's a lot of government employees who are out of work. The employment numbers coming out of 2024 were not very good. Every time in 2023 and 2024, fact is, I won't say every time, almost every time, and you can go back and look, every time they posted a good job numbers report, they had to revise it down because the job numbers were horrible. So we're seeing all of that change, but the problem is it takes some time for that to get rooted out, and there's a lot of people who are in that I would say that turbulent area, and they're facing issues with troubled assets. Well, how can we position ourselves, and what does that mean for us as investors? The reality is we go through these cycles, and people are going to lose houses, but somebody has to buy them. And so you can position yourself on the troubled asset side in a couple ways that we may not do on the regular open market side. Generally, when a property is a deed in lieu of foreclosure or a foreclosure, that bank's going to end up with that property, and they're going to post that for sale on the retail market, generally in an MLS in whatever area of the country it is. And that property is going to be available for anybody to purchase, and they can also purchase it with traditional financing. So you don't necessarily need to use high leverage private or investor money, hard money, any of those type of things. You can actually utilize a traditional investor loan, lower interest rates, and be able to get into some of these properties. Foreclosures that happen with Fannie and Freddie Mac sometimes can qualify for specific Fannie and Freddie financing. So there's some options on the troubled asset side that you can position yourself for now, and that would be getting yourself qualified and positioned in order to use traditional money, especially if you're a buy and hold investor. This is a very good way to do that. You know, if you're a buy and flip investor, generally if I'm buying and flipping a property, I'm going to use hard money anyways because it's easy in, easy out. But again, there's an opportunity to leverage this part of the market because the statistics don't look like they're going to be, this is going to be easing up anytime soon. Like I said, it'll probably be next year before we see some real advancement. I was looking at information provided by Freddie Mac. Interest rates had started to drop a couple weeks ago, but they're bounced back up to, on average, national average of 6.75% on a 30-year fixed rate mortgage. What is that doing? That's keeping traditional buyers out of the marketplace. So as troubled assets come on the market, it may give you a better opportunity to be able to acquire some of these assets when you're not competing with retail buyers. That's why I said get into it at the right time. And I believe that we really are there. I think that this is the time to start looking for some more of those troubled assets. It's a good time to find them before they become foreclosures, before they get listed with a real estate agent and become a short sale on the market. You can actually buy this thing out before it comes a short sale if you do it properly using some kind of either cash or investor financing money. It's going to take a little bit of marketing. You're going to have to use your systems in order to go out and find these properties. Mailings, postcards, knocking on doors, all those type of things in order to find some of these assets. But the number of them is growing. Foreclosures are up in the first 6 months of 2025 by 7%. And so it is definitely growing. We're seeing, tick up not only over last year, but over 2 years ago. Foreclosure notices, which are the ones that are going out from the bank when people are late, are increasing. Well, how do you find these things? Get with your local title rep, your preferred title rep, and have them run reports on people who are past due on their mortgages. This can be a great way to find some of these properties. I was looking at, Mortgage Point put out a report on some of the U.S. foreclosure statistics, and it was showing that foreclosure starts are increasing nationwide. Now, there's going to be some pockets where it's much greater than other areas, but they are growing nationwide. And so I think this is a good opportunity, and the right time to start looking at leveraging these troubled assets. I don't think we're going to get back again to 2008, 2009, 2010 levels. But at the levels we're at, there may be some great opportunities to add some flips, some buy and holds, into your portfolio. So my final thoughts are like with most things, you have to take action. You have to get the information. You've got to be on the forefront. As soon as this becomes in the news cycle, as soon as this hits the news cycle, it's going to become much harder. Right now, I think that there's a window before everybody else has found out about this, everybody else recognizes this. I guarantee you some of the top investors already see this coming because they're looking at the same numbers that I do on a regular basis. But this is something, if you've overlooked it, if you haven't thought about it, it's something that you really need to take some time, do some research on. Again, get things in order, because I really think now is the time in order to take advantage of this. Hey, I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Be sure to check out our growing list of previous episodes on other real estate investing topics. I invite you to subscribe today and be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.